Welcome back to the Bitcoin Layer. Today we're joined by a very special guest, Mr. Michael Howell. Michael is the founder of CrossBorder Capital and the author of the critically acclaimed book, Capital Wars, The Rise of Global Liquidity. I've read it several times. Michael, thanks again for coming on the show.
Hey, Joe, great to be here. Thanks for the invitation.
Absolutely. So at the Bitcoin Layer, and our audience will know this, we love to bring on specialists in their field, experts in their craft to what they do. And I will say first and foremost that when I found your work at CrossBorder Capital, I was pretty astounded with the work that you've done in global liquidity. I found Capital Wars shortly after. Similarly, I was pretty amazed by the depth and the breadth of your knowledge when it comes to global liquidity. So I guess the first thing that I'll ask you here is we'll talk about liquidity. We'll talk about its importance. Obviously, over the last several decades, and you talk about this in your book, Capital Wars, the world's financial markets has shifted more so from a capital raising mechanism to sort of a refinancing mechanism, right? Where debt rollovers take on more importance than new debt issuance. And because of this, you talk about how the capacity of capital, which is what you refer to liquidity to, is more important than interest rates or the cost of capital. Now, for us at the Bitcoin Layer, we tend to view U.S. Treasuries, the suite of Treasury rates, as the most important price in the world. Over exchange rates, we feel that they're the most important price of money. Talk to us about how you've observed that shift to rollovers being more important than new debt issuance per se, and why liquidity is a more important metric to track than interest rates.
Okay, yeah, well, it's quite a long story actually, but let me first give a heads up to Salomon Brothers. That's where I pretty much began in the mid 1980s, and Salomon Brothers, the U.S. investment bank, as probably many people will know and many people won't know, was the preeminent investment bank worldwide. It was effectively the government bond market. Salomon was a huge proprietary trader. A lot of the financial techniques that we know and love today were actually invented by Salomon Brothers. So it was preeminent in its field. And the head of research, Henry Kaufman, was really the doyen of flow of funds accounting. And Henry used to use liquidity as really a guide to understanding the US Treasury market. So that's really the beginning of the story. Why is looking at liquidity today so important? I think it comes back to probably one key event, if you want to put it onto one thing, and that is the entry of China into the world economy, and maybe specifically the entry of China into the World Trade Organization at the end of 2001. Now, one of the consequences of China's entry was that the world began to experience disinflation, and many central bankers, particularly Greenspan, Bernanke, to name names, feared that this particular transition wasn't a beneficial, let's say, cost deflation. It was a pernicious monetary deflation. And from the experience of the 1930s, we know that's bad. And so as a result of that, they began to slash interest rates. Now, the problem with slashing interest rates is that interest rates may be a way of stimulating monetary policy, but it also encourages debt, it incentivizes debt. And so what you saw through that period was a tremendous appetite and availability of debt. Debt was cheap. Now, as a result of China's competition, what you saw were a number of zombie companies who couldn't really face up to the heightened competition. And so they absorbed a lot of this debt, or they basically issued a lot of debt. And so what you saw, particularly from the beginning of the 2000s, was a very rapid growth in US debt take up. So the debt GDP ratio spiraled upwards. Now, if you have debt has a maturity, a life. So the average maturity of debt that's sitting out there now is around about 5 years. That pool of debt now totals well in excess of $300 trillion worldwide. That's how much it's grown. If you divide 300 by 5, you're talking about 60 trillion of debt. It's at least that number that has to be rolled every year. Now, if you're rolling debt, and let's think of a specific example like a home mortgage, and your home mortgage is coming up for repayment and you can't repay, you've got to roll that position. It's not the interest rate that really matters to you. Clearly, it's important, but it's not the crucial thing. The crucial thing is getting the roll, finding someone who's going to lend to you. If you don't, you're homeless. So it focuses the mind. And that's the same with debt. You have to repay the debt, otherwise you default. And that is unacceptable. So effectively, it's the flow of liquidity that's important, because liquidity measures balance sheet capacity. And balance sheet capacity is what's needed to roll the debt. So that's why liquidity, the volume of liquidity, is so important. So if we go back and look over the last 2 decades, most financial crises have not been triggered by specific debt to GDP ratios, which is what the academics tell us. It's when liquidity has got out of step with debt volumes. In other words, what you need to think about is a fairly stable relationship between debt and liquidity.
That's a fantastic response. And so that brings us to, I suppose, chart number 5 that you have here, which is your global liquidity index. And you've actually mapped out that relationship, sort of with the liquidity cycle. As it ebbs and flows, you can see crisis happens sort of beneath that 50 line, sort of that midline per se. And then towards the peak of the liquidity cycle on your global liquidity index, you tend to see where the public usually, when we're referencing like massive monetary and fiscal easing events, these are usually what we're referencing: QE4, QE6 with the COVID crisis, China easing in QE1. So what is this global liquidity index actually comprised of? How is this something that you guys go about calculating?
Okay, well, it's first of all, the important thing to say is it's global. So this takes into account 90 economies worldwide. Now, clearly on that definition of 90 economies, there's a long tail in that. And it's only really maybe half a dozen economies: America, China, Eurozone, Switzerland, etc., Canada, Australia, which are really important. So they're the ones that really concentrate, that we tend to focus on. But we're comprehensive. We look at everything. So number one, it's global. Number two is it's not money supply. Now, that's a very important thing to stress. Money supply is a measure of the liability side of high street bank balance sheets. So it's retail money, okay, essentially. But if banks get their funding, all their funding, from bank deposits, retail bank deposits, then money supply is a good gauge to liquidity. Liquidity is really the other side of the balance sheet, the asset side of the balance sheet. And it's actually bigger than banks. It includes shadow banks. So the difference between liquidity and money supply, which is what people maybe are more familiar with, M2 or M1 or whatever, the difference is that number one is includes non-deposit financing, so things like repos or debt issuance. And number two, that it also includes, beyond banks, shadow banks. So in many cases, we say that liquidity under our definition actually begins where conventional monetary aggregates end. That's a convenient way of putting it. It's effectively wholesale money that is flowing through financial markets. And that's really the key difference. You wouldn't expect global liquidity to give you a good heads up to high street inflation, but you would expect it to give a very good prediction of asset price inflation.
Right. That makes sense. So let's shift gears here now. And you talked about how this global liquidity measure, it takes into account repo transactions, debt issuance, all of sort of that financial plumbing that isn't observable on the surface with regular M2, which is, obviously just retail deposits. And as you said, that would be an accurate measure of liquidity, if not for other funding sources, which really drive global finance more than normal retail deposits. In that vein, I want to talk to you about bank reserves. Because these have sort of been the talk of the town as of late. This is the Fed's second attempt at quantitative tightening, whereby letting assets mature off of their balance sheet, including treasuries, mortgage-backed securities, and the like. They are removing bank reserves from Fed banks. Now, as of right now, sort of this can be thought of as the capacity of capital in the interbank market, at least a very good portion of it. And so obviously the Fed has pretty large influence here when it comes to the level of that. It's declined from, I think, 4.2 or 4.4 trillion to now 3 trillion. And the often cited level of where the Fed's ample reserves framework won't be so ample anymore is 2.5 trillion.
Mhm.
I see in your chart here that you've referenced that level. I think Jerome Powell has also explicitly referenced that level. If not, it was another Fed speaker. Um, Talk to us about bank reserves as of right now. Why are they so critical for our listeners? Why are they so critical to the functioning of U.S. dollar money in capital markets? And is there a level below which, if they drop, things start to get hairy?
Okay, well, the answer is that they are important and they're not important. So let me just set the stage a little bit. In terms of the charts that we can reference to demonstrate the importance of global liquidity, you need to look at slide 6, which is looking at how asset markets react to liquidity. And what you can see on that is an extremely tight, but more importantly, a tightening correlation over time. So liquidity is the main driver, and you may want to look at the subsequent slide 7, which actually shows how responsive crypto and gold, the traditional monetary inflation hedges, are to those movements in liquidity. Now, what I go on to show on another slide 9 in the slide deck is the structure of global liquidity. And global liquidity is a pool of funds of about $170 trillion. It's the private sector that ultimately creates that, but it rests on a base. And we think of that base as a monetary base, or probably more correctly now, what we term a shadow monetary base, because it's not just central bank money or bank reserves, it's also factors like collateral, and it's also factors like offshore pools of cash, for example, the euro dollar markets or operations that involve FX swaps. These things are increasingly important. More and more, the financial system is operating on collateral. And that was one of the things that came out of the 2008 GFC, global financial crisis. Banks don't lend on trust anymore. They need collateral, and that's important. Now, to come to your specific question about US bank reserves and what's going on, I think one has to go back to understand the events in more detail of September 2022. And in September, the British gilt market melted down because of a mini budget statement that the temporary incoming Prime Minister Liz Truss proposed. That was a pro-growth budget, but the markets didn't like it. And consequently, the British sovereign debt market, the gilt market, sold off. Now, the Bank of England came in with some alacrity, reversed their QT policy overnight, and engaged a QE. But the key point here is that had that same event happened in what you correctly pointed out earlier on is the most important financial market in the world, the US Treasury market, would have had a global financial crisis without any question. That, I think, was a wake-up call for policymakers worldwide. And what you've seen since that date is principally, I think, two things going on generally, but let's focus on the US to evidence that. The first is that US bank reserves have effectively flatlined since that point. And increasingly, the Federal Reserve has created some mystification, let's say, about its QT program. So most people would understand QT as being the reverse of QE. If QE was injecting liquidity, QT is removing liquidity. But the best way of gauging liquidity in the US money markets is to look at bank reserves. But hey, they flatlined. And what the Federal Reserve is already saying now is its QT policy actually has to be gauged through the roll-off of treasuries on the balance sheet. Nothing about liquidity. It's all about whether they reduce the balance sheet by getting rid of treasuries. Reducing the balance sheet doesn't necessarily reduce liquidity because every item on the balance sheet is not liquidity creating.
Mm.
And so what they're doing is they're having their cake and eating it. And what they're doing is, if you reference the chart, for example, the one that we put about bank reserves, which is chart 14, what you can see there is that there are three lines on that chart. One of them is the orange line, which refers to US bank reserves, which are rolling on at about 3 trillion US dollars. Each weekly observation is about 3 trillion. And it has been each week for the last 22 weeks. I've put a one standard deviation lower bound on that to show the normal fluctuations. But hey, we've got the debt ceiling issue. We've got great seasonality in tax payments. So, maybe that we need to be a little bit more generous on that one standard deviation, but hey, let's think about it where it is. And another dotted line, which is horizontal at 2.5 trillion. 2.5 trillion is what many US academics, and you referred to Jerome Powell as well, are citing to be the minimal operating level for US banks. And if reserves go below that level, there may be refinancing problems in the markets, as we saw back in 2019, where the repo market sold off. Every major financial crisis in the last 2 decades has been a refinancing crisis. It's all about liquidity getting out of line with these excessive debt loads. The 2.5 trillion was referenced by Jonathan Wright talking at a Brookings conference in September. So this is a well-known figure. We do separate estimates. We get a similar number, maybe ours is a tad higher, 2.6, 2.7, but hey, it's more or less ballpark. And what the Federal Reserve has been doing has been effectively shadowing that minimum level for the last few weeks. Now, what does it mean in reality? What it means is that what the Federal Reserve is doing in conjunction with the Treasury is trying to reduce bond market volatility, in my view. What you've seen is bond market vol come down. Why is that so important? It's because we live in a collateral-based world. And if you want sort of changes or iterations in the development or evolution of the Federal Reserve, one major evolution occurred in 2008 with the GFC, when the Federal Reserve switched from being lender of the last resort to being dealer of the last resort. Okay, in other words, it was operating less in banking markets and more in repo markets. They've tried to enhance that role over the last decade, so we've now got a standing repo facility which is available, and we've got the Foreign Monetary Authority repo facility as well on top of that. But the key problem that I'll make is that maybe the markets have got even too big for the central banks here. And so what the monetary authorities are doing are moving up the curve to try and control collateral directly. In other words, if you control the treasury market, the sovereign debt market, then you're going to get a lot more chance of controlling all the markets, because collateral is so important for liquidity. And if you stabilize these markets, reduce volatility, you're going to be able to get more lending out of collateral bases. And what the US is doing is what Japan is doing, is what the Bank of England is doing, and I would suspect is what the ECB is probably doing as well. So in other words, Japan may here have been the canary in the coal mine. This is how we view Japan. We had bad demographics there. We had deflation there. We had zero interest rates. We had negative interest rates. We had QE, QT, yield curve control. Japan exports all these concepts to the West over time. So yield curve control is coming to a high street near you soon, but it may be a more subtle type than we've seen in Japan.
Phenomenal points. It seems as if, and you're exactly right, it's a very, very prescient point that I think should go home to our viewers, is that with QT and essentially really, really stressing whenever they have the chance to talk about it, how they're rolling off several billion in treasuries every single month, but that's not reducing one of the most important facets of liquidity in the system and for regular financial markets functioning, which is bank reserves. And so they're managing inflationary expectations, which is basically the one of the other policies that they've adopted is, rather than being able to manage inflation directly, managing inflation expectations is just as important. They're able to manage those effectively by showing how much they're rolling off their own balance sheet, but they're having their cake and eating it too, because actual bank reserves aren't falling very materially. They've flatlined since September. And I want to get your thoughts on the transition to secured financing standards. So obviously, you mentioned in the wake of 2008 that basically banks would lend to one another off of nothing more than really their word, right? LIBOR was, it was this construction of a reference rate that was fraught with corruption and collusion. And off the back of 2008, where it was found that there could be a whole host of shadow risks and these deep layers of fragility within the banking system, there's been this concerted effort to move towards secured funding standard. And things like SOFR, which is in the process of finalizing its rollout. this year. I know it's been finalizing its rollout for the last 2 years, but we're approaching a few key dates, namely in April, I believe that CME Eurodollar futures contracts will now be using SOFR as their benchmark
Correct.
rate. And then
Right.
in June, I believe LIBOR stops publication altogether.
Right.
So as the Fed and other central banks seem to have understood the necessity to manage fixed income volatility, particularly the U.S. Federal Reserve in the U.S. Treasury market, because it's the world's most widely used collateral asset. Moving into a secured lending standard, does the central bank's role fundamentally change to sovereign debt market stabilizer as a
Yeah.
result of the U.S. Treasuries in particular through SOFR now making up a much more important layer of the financial system?
Exactly. So I think you've nailed it, Joe. So basically, what you've got is the next iteration, which I think we basically saw evidence of from September, is that central banks have moved from being dealer of the last resort to being active collateral managers, and that's the key point. So that's why I say yield curve control is important, because that's what they're going to do. Now, it doesn't necessarily mean that they fix an interest rate. What it may mean is they try and massage bond volatility. But what they can't have is spikes in bond volatility, because that will destroy the collateral mechanism, because effectively margin requirements will go up or haircuts on collateral will be raised. And so credit will come down dramatically. And one of the problems, there are virtues in this system, but one of the big problems is that the whole financial system becomes a lot more pro-cyclical under this arrangement. So the Federal Reserve has got to be a lot more active, or the Fed and the Treasury together have got to be a lot more active in terms of managing these risks. Now, if you look at a slide that I had earlier in the deck on slide 10, there is a chart there where we actually graph what we call the shadow monetary base. So this is the aggregate of central bank money worldwide plus collateral plus cross-border flow money. In other words, the size of these offshore pools. Now, what you can see in the graph are two lines: an orange line which refers to a 12-month rate of change, and a 3-month annualized rate of change, which is a thinner black line. That spikes higher in the first, really over the last, since the fourth quarter of last year. So you've got a big increase coming through. And that is partly because bond volatility has dropped, and so the effective collateral multiplier has picked up. And the second thing that you've got is that central banks around the world have been opening the money taps to some extent. Now, we covered the US. The US hasn't exactly flooded the system with liquidity, but I would say that it's arrested the decline in bank reserves. And if you look at where bank reserves probably would have been or slated to be, assuming that the Federal Reserve was running treasuries off its balance sheet at a fairly constant hum, they're probably sitting 500 billion above where they should be right now. So that gives you some idea about how the Fed has changed. And we would argue, as you infer, that probably there's a bifurcation in monetary policy now. So interest rates are going to stay higher for longer because they're the weapon to kill inflationary expectations, but the balance sheet's being used for financial stability. Now, it's not only the Fed that's changing, others are. And we've got to think about Japan, and we've got to think about China in particular. And both China and Japan have put a lot of liquidity into their money markets through central bank operations. Japan is doing it for financial stability reasons as well. A lot of the arguments that were made at the end of last year were that they were basically buying JGBs or shifting their target ranges to improve liquidity in the JGB, the Japanese government bond market. I think that's quite plausible. That's not to say they won't raise interest rates in the next few months, but that's a different question. But I think this was generally a treasury market liquidity move. And then you've had China, which is doing very different things. China's not operating a yield curve control. What China is doing is just trying to, plain and simple, goose its economy after the COVID lockdowns and the reopenings. And the scale of liquidity injections that the Chinese are putting into this system are kind of eye-watering. In December and in January together, they've injected 3 trillion yuan, which in proper money is 450 billion US dollars. Now, to scale that represents about 3.5 times what the Chinese put in the previous 2 years in total net. So they're going for it, okay? And what we've seen through February is it's been a little bit more up and down, but generally the trend is increasing. So they're trying to get the economy stimulated, and I think what you're seeing is the evidence of that. Looking at the commodity markets, for example, and the turnaround you've seen in a lot of business confidence surveys through January.
Absolutely. And so it seems, so by your measure, is the inflection that has occurred recently in global liquidity a combination of not just the Fed, but sort of this concerted effort by central banks globally, uh, this new understanding that they have to stabilize their sovereign debt markets. They can't allow them to sell off like they did in the UK. And as a result of that, interbank liquidity is flatlined. In some cases, it's inflected back upward. That's the first component of global liquidity now rising on a year-on-year basis, and it's also these tremendous liquidity injections from China
Correct.
in order to spur its economy. Are those the two primary components of the rise in global liquidity? Are there any others?
Well, they are, but I think the other thing, as I alluded to, is that the drop in bond volatility increases effectively the collateral multiplier. So I think one of the corollaries, one of the takeaways, or maybe the important corollaries of all this, is that whereas equity investors or many investors have looked at the VIX index of stock market volatility as a good guide to risk historically over the last 2 decades, say, in future they got to look at bond market volatility measures like the MOVE index, which is published by Bank of America Merrill Lynch. That is a measure of vol across the Treasury curve, and that's really a key heads up to what's going to happen, because that really gives us a lot of input about how liquidity could be shaping up in future.
Absolutely. To touch back on China for a moment, and I totally agree. I think moving into, particularly with SOFR and the proliferation of a new secured lending standard, I think much more so than taking a look at VIX and sort of using it as gospel. I think more and more investors will be taking a look at fixed income volatility in things like the MOVE index, but also Treasury market volatility when they're making their financial decisions and their decisions as to where they position themselves on the risk curve. Because we saw last year, I believe the worst sell-off across the U.S. Treasury curve in several decades. I don't know the actual figure, but we saw a pretty awful sell-off last year. And I think what happened in the United Kingdom was really the warning shot across the bow that, okay, if you're going to move as a world to this new secured lending standard, then you need to take a much more active role in your government fixed income markets. Does that also change then the way that the Treasury goes about issuing debt? Is there a necessity for the Treasury to also take a much more? It obviously adjusts its issuance schedule based on the prevailing needs and wants of investors, and itself, of course, for funding purposes. But are there any fundamental changes that will occur when it comes to Treasury debt issuance as we move into the secured lending standard?
I think it's an interesting question. I mean, off the top of my head, I can't really think of a sort of plausible response to that. I think it could do. I think that what you've got, let's say, pretty archaic settlement and trading in treasuries right now. For what is the world's biggest market, you need something beyond an OTC market, and I think that's maybe central clearing or whatever it may be. You need something which is more sophisticated and more appropriate for the time. So I think market depth is important. One of the things that many people are advocating the Fed or the Treasury to do is to focus a lot more on the run versus off the run treasuries. I mean, these are sort of, if you like, liquidity swaps that they would do. So they'd basically take out an illiquid issue and issue a fresh security, which tends to have more liquidity. So there are a variety of tricks that could be done. But I think one of the things that I would tend to focus on in terms of understanding the treasury market is to look very closely at what's happened in the US and in the German Bund market in the last 12 months. And in particular to see that the change in rates or the rise in yields at the longer end could have been far, far worse. Okay. So if you look at how rate expectations have shifted, rate expectations have gone up, but they have not hit the long end of the curve pari passu. So what's actually happened in technical or wonkish parlance is that term premia around the 10-year tenor have dropped away dramatically in those two markets. Now, that would suggest, in my simple view of things, that there is a fundamental shortage of collateral in the system. In other words, that's the type of pristine collateral that investors really want in tough times. And therefore, when tightening begins, investors start to go for the safety, or they presume safety, of these issues. And in fact, had the had term premium not fallen in the case of the US market, the 10-year yield will probably be well over 5% by now, given the aggressive moves at the front end of the curve. So I think one of the other things to start thinking about is collateral, and collateral supply is very important here. So that's why I think, going back to this whole equation, the Treasury and the Fed have got to get together and think about this collateral management issue. Now, that is an interesting debate once you start to roll out over the next decade and you think about the sort of issuance that may be likely in terms of Treasury coupon over that period. And, I think it's fairly easy to see that with the deterioration in the health of or the fiscal position of many countries, but the US is the US may be the cleanest shirt in the laundry here, but it's still got a lot of problems. And aging demographics means that entitlement spending is basically a big figure and a growing figure, whereas the tax base is effectively flatlining because of an aging working population. Now, on top of that, we've got defense spending. And if you start to look at the latest projections that the Congressional Budget Office have recently made, what the Congressional Budget Office are actually saying is, even making relatively conservative assumptions about future defense spending, which I'll come back to, what you've got is a level of Fed take-up of Treasury debt, which will mean that the balance sheet of the Federal Reserve swells towards 10 trillion by the end of the decade. So in other words, anyone that thought that QE is dead and gone away, think again. It's coming back. Okay, there's a dogleg in the data. We're going down for a bit in terms of Treasury holdings, but believe me, we're going up fast in the next few years. Now, those projections, which are in the public domain, anyone can look at them. Those projections assume a level of defense spending of just a tad over 3% of GDP. I would suggest that's way too low, given the heating up of geopolitical conflict with Russia and with China. Okay, even in the last 2 or 3 weeks, this has become an issue. If you take a 5% share of GDP, and maybe you can embed in that an assumption that the US has to effectively bankroll Europe in terms of defense spending as well, because the Europeans are never going to get their act together here. What you've got is the prospect of even more Treasury issuance coming. So in other words, my idea or my concept or fear, or let's say projection, whatever, of yield curve control coming to a high street near you is a realistic thing to think about. In other words, you don't really want to be embedded in government debt if you can avoid it. You want to think about other areas. You may want to think about equities. You may want to think about commodities. You may want to think about corporate debt, although that's clearly going to be, still hampered by the government markets. Or you want to think about crypto. This is not an investment recommendation with crypto, but let me say, these are alternatives.
Got it. Absolutely. Yeah, we don't worry. We have financial disclaimers in our description as well. And thankfully, we've got a lawyer on hand to help us with those too. But so over the next decade, there's going to be this structural shifts to where the Treasury and the Fed have to work more in confluence with one another, sort of blurring that line. We've always known that the Federal Reserve, it's not federal, it's essentially a branch of the government with how closely they work together. And that relationship is going to grow even closer over the next decade as bond market stability is an absolute necessity, and the issuance schedule may need to adjust accordingly to the needs of world financial markets, as more treasuries are needed and more stability is needed in order to lubricate normal financial flows. And as such, treasuries, government debt may not be the most attractive asset class to be into as as the Federal Reserve grows into more of the marginal dealer of last resort within there. One of the and you bring up a very good point. One of the points that uh, I've been drumming for quite some time, and that we hold here at the Bitcoin layer, is that Bitcoin is an asset, while as of right now, it's sort of viewed as this extremely sort of risky asset, whereby the people who trade it just like an equity. We view that it's sort of insurance on monetary debasement per se. Now, obviously, the actual removal of liquidity from the system and the expansion of liquidity from the system, that leads actual observed CPI inflation by several months. And so when inflation's rip roaring, and the Bitcoin price is falling, naysayers will point to the fact that inflation is extremely high and that the Bitcoin price is falling as, see, it's not an inflation hedge, but they're looking at the wrong type of inflation. They're looking at CPI inflation, where they should be looking at monetary inflation and also monetary disinflation, which we're experiencing right now to a pretty precipitous degree. And so I think it's a great point. And it's a great point that our listeners should take home, that if you do believe this over the next several decades, this shift will occur, where central banks become more and more involved in the government bond market and monetary expansion is slated to continue, you may want to consider positioning yourself in an asset class that's a good proxy for that monetary expansion. Obviously, being equities, corporate debt, as you mentioned, but also Bitcoin. Bitcoin tracks the liquidity cycle with pretty high sensitivity. And if you are of the belief that monetary debasement is to continue, positioning yourself in Bitcoin, which has 400 billion, 500 billion market cap right now, you've got some pretty good upside there. So for our viewers at home, just a small point there. If this is to play out as you expect it will, and as I certainly expect it will too, let's talk about where we're at currently in the business cycle and sort of your views for the next 6 to 12 to maybe even 18 months. So you have here one of the last charts that's in the deck of the global liquidity cycle, chart 21, and you show that the liquidity cycle precedes the economic cycle and risk appetite by 15 to 20 months. Given that we saw global liquidity inflect sort of last September, and we started observing that shift then, as of right now, we're beginning to see risk assets on the rebound, not just equities, but also Bitcoin and other really high beta assets as well. Over the next several months, obviously, risk assets are looking forward to something like a Fed normalizing the policy rate, so stopping their really aggressive hikes and eventually pausing. And historically, the Fed pause rally per se, that's been something that's occurred in every single version of the during every single cycle, except for 2000 and 2001, where equities were still tremendously overvalued. So as equities are rallying with sort of the hopes of a Fed pause coming up and the liquidity cycle inflected back in September, in your purview, what's the path for equities, risk taking, and credit? Because credit's also doing quite well now too. Spreads have been coming off their highs for several months now, since I think October, shortly after the liquidity cycle inflected. Do you think 2023 looks more like a year for risk taking than 2022?
I think that as the year unfolds, the short answer is yes. Our view is that the liquidity cycle globally definitively bottomed in October of last year. I would have 100% conviction that liquidity is going to expand on our measures through this year. Okay, point number one. Point number two is that if you look at, as you rightly say, if you look at liquidity, it precedes the economic cycle. The economic cycle is likely to turn this year. In some cases, it's already turning. I think that you can probably reference one chart, which is chart 12, which basically shows what the Chinese People's Bank has been doing in terms of its liquidity injections. I foreshadowed that earlier on. The PBOC is going for it, injecting 3 trillion yuan in the last 2 months alone. And the correlation between Chinese PBOC liquidity, the People's Bank, and the world business cycle is remarkably close. And if you project what the PBOC is likely to do, you get a very clear view that the cycle is turning. and you can actually you can embroider that same view by looking at commodity markets as well. So it's all pretty much on track. So it looks like there's an inflection largely coming. To get a further insight into that, when we do our asset allocation, we like to take several views of different market areas. We like to view the fixed income markets separately from the economy, separately from liquidity. If you look at another chart, for example, chart 17, which looks at the Federal Reserve and the profile of our index of Fed liquidity in blue for this cycle compared with the Y2K cycle, which basically covers the period you cited, which is 2001, 2002, then you get a pretty good heads up of where we are. It looks exactly on track. Now, what happened in 2001, 2002, you basically got bond market volatility dropping. You started to see the corporate bond market outperform. You started to see commodity prices racing ahead. The government market, if I recall, in 2001 gave you a moderate return, not an exciting return. We think that both Treasury and broad equity markets will be essentially flatline this year or be in trading ranges, but there will be opportunities in certain segments, of which I noted corporates are one. You'd also expect to see, as I say, commodity markets picking up. You'd expect equities to get traction as the period lengthens or unfolds. In 2001-2, equities came off a very much higher valuation base. They were much more expensive coming in to the floor of the tightening cycle. And what's more, we saw the horrific events of 9/11 as well, which came in the middle of that period. So Pache, we don't get anything like that. Equities should get more and more traction as the year unfolds. To get a good heads up of what the liquidity cycle looks like, slide 18 is looking at the long run perspective of how the liquidity cycle unfolds. And this goes back to 1970. It shows recurring cycles. This is the global index, which ranges between 0 and 100. It's already bottomed, as I suggested. It's likely to pick up, and we think it will top out in 2025. Now, as you can see from the data, another sort of health warning is that markets don't move in straight lines, and neither does liquidity. So we may get some wobbles en route, but generally the trend is higher. And what we've got now is we've got the wind behind us. We're not facing a headwind of liquidity, so that tailwind should be supportive of markets, we think. And in terms of where should you go for asset allocation, there's a matrix, I think, on the last slide 22, which basically looks at how we invest money. And we tend to think of investment as having regimes or zones. That is based entirely or keys off the liquidity cycle exactly. Where we've been, I should say, is in a phase called turbulence, not surprisingly. That's been occupying everybody for the last 12 months at least. That is a phase where volatility-based strategies, things like CTAs, cash, US dollar, defensive growth stocks tend to do well. Okay, and that's pretty much tick those boxes. The next phase up is what we call rebound, when you're starting to get more traction out of fixed income arbitrage funds. Corporate credits tend to do well. You tend to find that bond vol comes down through that phase, and you can make money out of certain equities like cyclicals. Now, if we're correct in our view, the world economy is turning courtesy of China, and the Treasury market here is kind of flatlining, you kind of want cyclicals over growth stocks, in my view. That, I think, would make more sense. And to put it in very, and I'm going to say very simple terms, the way that we tend to think about equities is to say, look, if you think of equities as having two moving parts, a PE and an E, the Federal Reserve is controlling the PE more and more, and the E is being dominated by the People's Bank of China because of China's large industrial footprint. So what you're basically seeing is a situation where the E may be more supported than many analysts think because of China's goosing of their economy, and the PE may be held up by what the Federal Reserve is doing now. So if you look at those two moving parts, cyclicals get more of their traction from the E, and growth stocks get more of their traction, linking with the PE.
Fantastic. So cyclicals in this period stand to do well as equity valuations get supported. I was actually just about to ask you about that because I heard you talking about how the P comes from the U.S. and the E comes from China. But thank you for touching on that. And this is a great asset allocation matrix. And lo and behold, what is doing well now as we head into rebound, this phase that you're talking about, is credit. Credit is doing well. As we as credit risk ameliorates, liquidity begins turning, and market risk begins sort of turning the other way as well. Prior to this call, I had tremendous respect for your markets framework, and after speaking with you, I have even more respect for your markets framework. I think
Thank you.
absolutely. I think it's one of the most robust and accurate through time frameworks that I have seen in, of course, my very, very short time in markets. I'm sort of a new guy here, relatively speaking. The last question I'd like to ask you before we sign off here, and again, this has been tremendous, is as the liquidity cycle begins turning, as China is easing to an extreme degree as they are now, and the economy in the United States domestically, it's much more robust than most people expected. Equity valuations, earnings reports, they're coming in bad, but that's mostly for sort of the tech firms, the very, very highly interest rate sensitive firms. They're holding up moderately well. As the economy remains robust, as China begins easing to a tremendous degree, and as this liquidity cycle, we're well on the way of inflecting back upward. The one flying the ointment seems to be, and I want to ask you about this, maybe CPI inflation. We still have CPI inflation in the 6 handle. It's coming down pretty materially meeting after meeting, but we just saw in this meeting, it was marginally, I believe by a tenth of a percentage point, higher than analyst expectations. Do you feel that as the economy is more robust than was anticipated, the liquidity cycle is inflecting upwards? Clearly, to some degree, animal spirits are back in risk markets. Do you think that there's any potential risk that as global growth moves back in the upward direction, that there's a risk to CPI potentially being stickier than anticipated, and a monetary response that comes after that being more extreme? Do you think there are any downside risks there?
Yes, I think that there are two considerations here. I mean, one is to say that if you come back to high street inflation, it's got two moving parts. And I think, Joe, you cited those earlier on. One is monetary inflation and the other is cost inflation or cost deflation, whichever applies. And what we've enjoyed for much of the last 2 decades is cost deflation because of China. And you might, to use the dreaded word transitory, that may have been a transitory phenomenon, okay, but it lasted 20 years. And that may have been lost now. So we don't want to get the same downward push from costs that we've been seeing over that period. And what we've got are different cycles of money. Now, I'm going to revert away from liquidity, which is a financial market concept, back to money, which is more of a real economy concept. And if you look at traditional money supply measures, they are really tanking, right? So things like M2 are negative growth. That would suggest to me that given the strong relationships between money and high street inflation, what you've got is a tumbling of inflation rates through this year, okay? But I still think that inflation is going to be volatile and probably a higher trend level than we've been seeing. I don't think dramatically higher, but I think what we've got is, to use your term, sticky inflation, but also volatile. There'll be shocks in inflation. Now, to my mind, what the Federal Reserve is doing here is it's copying the script that was originally laid down by a British journalist called Walter Bagehot, who wrote a famous book called Lombard Street in the 19th century. Jim Grant, the sort of doyen of central banking in America, has written a fantastic biography of Walter Bagehot. But Walter Bagehot's important because he was observing the roller coaster money markets, the then repo markets in Britain in the middle of the 19th century, after the failure of a big shadow bank called Overend Gurney, which was then the world's biggest financial institution. It went bust, and the Bank of England refused to bail it out. And that basically caused a tumble in the money markets. What Walter Bagehot said was, this is what central bankers have to do. They have to lend freely at a high rate of interest against good collateral. And that is the recipe for central banking in these markets. What our central bankers have been doing for much of the last 20 years is doing the absolute reverse of that. They've been lending at low interest rates against poor collateral and not making that much liquidity available. And that's where the problem is. You've led to this huge pickup in debt, and debt is the problem that everybody faces. We've got to get rid of it. Now, to answer your question specifically about debt, is is the Federal Reserve going to do a Paul Volcker and basically smash the system and get that debt down, kill inflation? Yes, but no. They will do that, I think, but this year is not the best year to do that. And the reason it's not the best year is you've got a war going on in Europe and you've got tensions with China. Why do you want to derail the economy right now? There's no reason to do that. What you can do is let a little bit of inflation pass through the system. You basically monetary devalue some of your debt. And then if you want to tackle the debt burden with high interest rates, do that down the road. Don't have to do it right now. You can kick the can down the road, to use the politicians' parlance right now. And that's what I think is going on. So in that view, that's why I think that you've got liquidity coming back into the system, and why you've got to start rethinking asset allocation for a more benign liquidity cycle in the next 2 years.
Right. Very well said. We're moving into a totally new paradigm in terms of global liquidity dynamics as we move to a secured funding standard. We're potentially moving into a phase where rates are at a much more regular level. Here, we allow moderate, potentially structurally higher inflation to pass through the system. And of course, treasuries now have a much more regular part in that system through SOFR and other secured lending standards. Absolutely fascinating stuff, Michael. Before we sign off here, where can people find you?
Well, they can find us through our website, which is crossbordercapital.com. I wrote a book about this stuff that you referenced, I think, earlier, which is called Capital Wars, which is published by Palgrave Macmillan. That's available through Amazon, I'm sure. And we've got a Twitter handle, which is @CrossBorderCap, which is pretty active. And there's a LinkedIn site as well.
All right. Fantastic. Well, Michael, thanks again for coming on the show. And thank you, everybody, for watching. Keeping it here at the Bitcoin Layer.
Great. Thank you.